Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in. Let's see what people are sharing on social media, and I'll interject my financial opinions. You can find me at Finding_Finance on Twitter, and you can join our community, finding-value.com, where I dive deeper into individual companies, sectors, and where I think the value is in the market. You can see what I am buying real time. So that we do have a discount coupon code still going on, LEAP, LEAP, at the moment. So scrolling on down, we've got value theory here. He says there's only one way to describe most investors: trend followers. Howard Marks. Yeah, that's pretty much the majority of retail investors and even a lot of institutional investors. Almost all of them are trend followers, and that's what it is. They will not be buying bottoms if you're a trend follower because the trend hasn't been established yet. If you're the one making a lot of money buying early and being patient enough for it to play out in your favor. Bar charts. The Biden administration will likely tap into the Strategic Petroleum Reserve in order to help satisfy summer gasoline demand, cautions Macquarie. So that is a potential that Biden will probably hit up here. Another quote says, "The higher the pessimism and related market fluctuations, better are the opportunities to enrich ourselves." So the next time someone asks you, does the stock correction affect you? You can answer, certainly, it improves my chances of getting richer if you take advantage of it. All of the big market fear bottoms have been excellent opportunities to buy. And when looking backwards, it seems very obvious when you look at history. But it is very dangerous, at least the perception that people have, when they're ahead of us. So I will say that. Someone asked, what the heck is going on in uranium? I know uranium sold off quite strongly in the morning. It has been recovering throughout the day. And guys, we all know that uranium is volatile. It's like we all know that. And when it actually occurs, people get afraid. It's like they can't help themselves from getting afraid or getting annoyed at the price action. I kind of just look at it and go, whatever, it is what it is. If I'm trying to get these, I'll call it decades of returns in a short period of time, the volatility is something that you have to just put up with. It's a part of the game, and you have to learn the game to master it. So, a part of it is dealing with these big pullbacks that we're getting in some of these stocks. And it's not even that big of a pullback, to be honest, guys. There are substantial rewards for adopting a regular routine of investing and following it no matter what, and additional rewards for buying more shares when most investors are scared into selling. That's that fear of the market. Peter Lynch is completely right. Your biggest opportunities are when you take an opposite stance of everyone else. So when people are buying in mass, you got to sell. And when people are selling in mass, you've got to buy. That is something that you need to learn as an investor, period. If you want to master this game, you have to do opposite of everyone else. It's the only way you can make any type of money in terms of large sums of money. You have to do opposite of everyone else. Another quote says, anything can happen in stock markets, and you ought to conduct your affairs so that if the most extraordinary events happen, that you're still around to play for the next day. The best require a margin of safety always. And that's what value investing is. And then you got to have the emotional fortitude to basically withstand anything that's thrown your way. And that's what the best guys, Peter Lynch and Warren, that's what they all say. Here's a Wyckoff distribution pattern, event break below support. So this is the NASDAQ, and it looks very similar to a distribution pattern. I've talked about this before about a potential distribution pattern occurring in some of these markets. We'll see if it actually plays out. That's what I'll say. I'll leave my opinions open about it, and we have to see some follow through. Some more quotes here. It says, you can't buy a good value investor without being an independent thinker. So you can't be a good value investor without being an independent thinker. You're seeing valuations that the market is not appreciating. And it's critical that you understand why the market isn't seeing the value. Another quote says, the only way for investors to significantly outperform is to periodically stand far apart from the crowd. That's being a contrarian. The art of investment is the discipline of inaction in the absence of a good opportunity, but aggressive action when one is identified. So you got to buy when a good opportunity exists and then do nothing. I put in here downtick in housing starts to 1.32 million, which is just above the average. I think the average that people were touting is actually 1.1 million. We're still above average, but it's obviously, you can see, slowed down a little bit on the right-hand side. But there's another opinion below, and we'll go over that. I won't go over mine yet, on the housing starts and the employment from it. Here's oil. Revisiting this bull, we see it has kept to the script, albeit with slight adjustment. We can also see the reason for the hesitation. So the hesitation is because we've got this resistance line that we're trying to break out of. But more than likely, we'll get a little bit of resistance where we're at. We'll pull back a little bit. And I know people always get scared of pullbacks. And then we hopefully surge higher coming this spring, summer, get above that resistance band and work our way on up to much higher oil prices. That is what I think is the most likely case. This pullback here could be from SPR releases or something like that. But oil still looks good, guys. We're just up against resistance. Miners have almost never been this cheap relative to gold. So here we are right now. This goes all the way back to 1940. We had a big move from 60 to 70 in terms of the valuations of XAU divided by gold. But coming down here recently, we are at all-time lows. Huge opportunity for those that can go against the grain here. How to not lose money in the stock market. Wait longer. Adopt a longer time frame. So as the data suggests, it says, as time horizons grow, equity losses fall off. The probability of negative returns based on the S&P 500 total returns from 1929 to present. You have a 6% chance of losing money on a 10-year time frame. 46% chance on a one-day time frame. 38% chance on a 1-month time frame, and you can see it just step down as your time frame gets longer. I have adopted this. It doesn't mean that I hold necessarily for 10 years, but the longer I hold, the higher probability that I turn positive becomes, so long that I'm buying the stocks that are undervalued. That is what I found in history with myself. And my holding periods that I have found have not been long enough. If I'm holding for three years or something like that, I need to hold longer. It seems like my returns would have been better holding even longer than what I have historically. And that's what I've adopted. Hedge funds are now the least long energy stocks in at least 5 years, according to Goldman Sachs. So hedge funds are the least long in the past 5 years. Bullish trend. Any attack on oil production or export facilities in Iran would drive the price of Brent crude oil to $100. And the closure of the Strait of Hormuz would lead to prices in the $120 to $130 range, says Andy Lipow, the president of Lipow Oil Associates. We've got the NDX and Huey here. The ratio at 87 signaled at the beginning of February 2024, as in 2000, the top of the tech and the bottom of the miners. So we've got a similar setup that is occurring right now. This is the NDX versus the Huey ratio. We are most likely at a peak where tech is expensive and the Huey is cheap, which is the gold and silver mining companies. So cheap for them again, 87, 87, a double top perhaps. And conversely, gold stocks, complete bottom and maybe a complete bottom almost coming up here. And now we're working our way on up or down in the ratio. EIA drilling productivity report. So Permian oil production declines are again increasing. Oil production in the Permian is not going to grow much in 2024 with this level of well completions. So indicated change in oil production, the legacy production change is down that amount, and production from new wells is up a little bit, so it's plus 12. And the Permian region oil production is basically flattening out here, potentially over the next, the past 6 months or so. And this is the Permian region legacy oil production. And it's obviously been declining for the legacy production change. So we're down 400,000 barrels. Shale explorers are drilling wells faster than they're fracking them, a signal that U.S. production growth is slowing. So shale adds more pre-drilled wells. The U.S. expands so-called Duke count for the first time in a year, and we have a slight increase in Duke count over the past year. Who's ready for 10% mortgage rates? The Fed hiking rates to 6.5% is real risk for UBS strategists. So we could be seeing a rate hike potentially. Here's Warren Pies on his opinion on housing starts. San Francisco fell back to 85,000 per month rate. No, that's got to be single family. Single family fell back 85,000 per month rate. Multifamily continues to make new cycle lows and is now fallen below 25,000 per month rate that we identified as the bear scenario. Single family points to decent growth. Multifamily recession deepens. On net, residential construction jobs are not at risk at these rates. So in his opinion, the recession threshold is somewhere in this range down here. We've been just moving sideways up here. And the bear case, it puts us into a recession out in 2025 middle. The bull case, we completely avoid a recession, and the bear case would probably be out in maybe 26, 27. According to this chart here in their research. So no recession in the immediate term. We'd have to really pull back in residential construction payroll for that to potentially occur. Buying bonds because you think stocks are going to fall has been the worst possible decision an investor could have made. That's the old paradigm. The old paradigm says, hey, look, if we get a stock market crash, they're going to lower interest rates, and a good spot to be is in treasury bonds. But that hasn't been the case. Interest rates have continued to go up, and bond prices have gone down or lower. JP Morgan insider trading alert. Chairman and CEO Jamie Dimon just dumped 178,000 shares worth about 32 million. He's now sold more than 180 million worth of shares this year. Wow, that's a vote of confidence. Here's Kevin Bamberl. Let's go through this. I wanted to read this one. Below, efforts to slow inflation are proving to slow the economy, but commodities will still turn higher. Why? Because we've been in a commodity bear market for a decade and a half, and there's not been sufficient supply investment in new production. Existing mines deplete, and it takes huge dollars and big margin incentives to fund new production plus time. We haven't even begun to find squat all new production this cycle, especially considering how aged the global infrastructure is and how many we need to build out and retool. Efforts to slow inflation with rate hikes will continue to hurt the broader economy more than commodity pricing. Short-term corrections may come in commodities, but then prices will ramp to new highs over and over again until commodities like copper hit $10 a pound. This bull market in commodities is going to continue with violent moves to the upside for years to come, until such time as the global financial market embraces and celebrates the bull market. We will need to see headlines about record profits in many commodity sectors and brokers raising stock price targets and clamoring to raise capital to fund new mining projects to supply the strong demand for the next decade or more. Only once these sectors raise record capital and see huge capacity expansions will the market peak. The road between here and there will be bumpy for sure, but the finish line is inevitability. We will see a glorious, broadly celebrated commodity bull market peak in a euphoric bubble. Buying in big here, and ignoring the noise for the next few years is our best bet to not miss out. And not just avoid missing out, but realize 5 to 10 times on mid caps and much more on some select small caps. Completely agree with them. And I would say the most difficult part for most people is to just hold through it. They're going to try to trade it. I tried trading the last bull market. Now, I wasn't nearly as good of an investor as I am today, but I still don't want to trade it. I traded out and never got back in. Keep in mind, I didn't really know what I was doing back then either. So I missed the majority of the back end of the bull market. Then I had some struggles because I was still a new investor, even in 2008 and 9. That would make me about 20, early to mid, it made me about mid 20s, late 20s. And I still made a bunch of mistakes. I could have bought the bottom in 2009, which I did. I did buy the bottom of a lot of stuff, but I didn't hold long enough. I had some, 100% gains or 200% gains that I had sold. I was lucky enough to ride up a couple of mining stocks that went ballistic from the bottom of 2009. They did like 10 baggers in like a year. And I was lucky enough to hold it for the majority of that 10 bag. But I could have done so much better than what I did, knowing what I know now. And really, what I had to do and what I needed to know was to gain the larger, big picture view, to learn the cycles, to learn that volatility is natural in a market, and that holding through it for the cycle is kind of that bright light that you need to follow. Kevin is providing that bright light in the commodity space for the next decade. That's his vision. We just read his vision of what's to come. And then you have to hold through it. That's another emotional kind of, you got to have the conviction and the emotional fortitude to just like ride through it. I'm doing that since the 2020 bottom and the stocks that I've purchased. I've been riding and I've had some pretty bad pullbacks in this ride. But it's not me losing money. That's not how I view it. A lot of people view the markets as losing money when their accounts are down. You're not losing money. It's just part of the game. It's volatility. And if you enter a stock and it goes up, and then they'll say, well, I should have sold it at the top and bought it at the bottom. All I'm going to say is, you don't know where the top is and you don't know where the bottom is. You don't know the exact path. So you can't make comments like that because your comment doesn't make any sense. You can't time it, so why are you even trying to time with any sort of certainty? If the market could be timed, if it could be, then where are all these billionaires who are market timers? They don't exist. They're all value guys that hold for long periods of time. And really what they're doing is they're being patient. On down, well, we've got Albert here. He says, I know we are no longer supposed to talk about Chinese deflation, but credit growth is certainly in deflation mode. In contrast to the growth optimists, this data doesn't suggest that the economy will be reviving anytime soon. And this is the demographic that drives it, guys. Their demographic has fallen off a cliff, and their housing market has basically crashed. This is what drives a crash. It's your demographic interacting with the real estate market and then going into an oversupply or hypersupply phase. And your demographic basically falling off a cliff. The Rio CEO, which is a diversified mining company, world isn't just facing a shortage of minerals, but a shortage of capital required to dig new mines, which takes far longer to develop than before. The gap is humongous, and I'm actually very worried about whether we will be able to close it. Yeah, that's what's coming, guys. So you've got all these CEOs, they look at the data. You've got Robert Friedland also talking about copper. And there's all these minerals that have huge shortages, and the insiders are like, I don't think we can close this gap. How are we going to do this? And all I'm going to say is it's going to get real interesting. This is what I invest for and what I stay long in, because I think the prices are going to go to demand destruction territory, which is way higher than what we've seen in the past. It's not even decade, guys. We're talking like the past 50, 60, 70, 80, 100 years. We've always been in this huge surplus and we could grow, grow, grow. But now we're going to switch from riding cost curves to demand destruction across the board. And this is going to get very expensive. And a lot of charts support that. Apologies for ruining doomsday narratives, but we are far away from an oil crisis. These guys, oh my God. It says the cost of Arab light crude adjusted by inflation is far from its peak. I don't know how this is evidence for what he is stating. I put this on here to talk about this. This isn't evidence. Evidence would be that we have a surplus and our inventories are growing. The price per barrel and the cost of it has absolutely nothing to do at all if we get into a shortage of oil, because it will be priced to demand destruction. Has nothing to do with the cheapest cost of producer in the world. I mean, what this is basically telling me is this person who posted this does not know how oil prices move or how commodity markets or how the markets in general even work. I'm curious to see how many follows this person has. 73,000 followers, and this guy doesn't know how to price something. Interesting. Asian and Europe onshore crude inventories have drawn significantly over the last 9 months and now sit close to operational minimums. Compared to previous oil price surges, there is much less slack in the system to pull crude from inventories and buying spot barrels. So this guy, he looks at the cost of Arab light crude, who has maybe 10% of the world's production, 10%. And he thinks that this is going to set the price, but at the same time, our inventories are at minimal operational minimums. That is where the shortages are originated from. They originate from the inventory levels being low and then driving the price higher. That is what it comes from. The cost of production of a low-cost producer that produces 10% of the world's production of oil is completely insignificant to the price of that commodity. It's a base production that is available to the world, but that doesn't mean they can grow this production at this price necessarily. God, it's unbelievable. Jeff Weiner, He talks about tech stocks. We've seen this before, and this is the movement that we've seen recently. We are still very cheap in energy beating tech, and we're still at a bottom. We're coming out of that bottom as we speak, and it just takes time. 2008 was a peak, and the bottom was September of 2020. Yay, that's where I bought it. Brandon says, remember when copper deficits were a 2025 and beyond problem? Not anymore. I talked about this one last time, so I'm not going to talk about it. So that's where I'm going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you haven't already. We still have the LEAP coupon code. I do have a Sunday question and answer session coming up at 5 p.m. Mountain Standard Time. That's the next one that's coming up. And if you're a member, I'll see you there. Go ahead and ask whatever question you feel free to. And I might go over this time. I've been thinking about it. Some mistakes that I've made, how I've prevented making those same mistakes. And it does tie into the 3 pillars and looking at things from a bigger perspective. So that's some of the things that I think I'll cover. It'll also be an update alongside it of the things that I look at, why I'm coming to some of the conclusions that I am, and we can kind of walk through it together. All right, guys, that's what I've got for today. We'll catch you next time. This is Finding Value.